Hey, good afternoon. We're going to take a look at some volatility across time frames. So I've got a 5 minute, 15 minute, 60-minute chart up top, and on the bottom I have a 300-minute, a daily, a weekly, and a monthly. So first, let's start with a top-down analysis. We'll start with the monthly. So you can see that for the month of February 25th through April, you can see the volatility was very high. That was that April tariff tantrum compared to when, the volatility for the month is like trading below the monthly two, for instance, very low volatility. Um, and then you can see the volatility rising here between June, July, going from the two to the three, where it flatlined right on the three. And then it peaked out, moving in September above the monthly three. And it looks like it was a pretty close, you know, measured move between the two and the three, doesn't it? Going outside the three. And you can see here it was stopped at 400. So if we zoom back in, you can see it was at 200. So it went two times the range, 200 to 400. I have pretty good eyes, don't I? All right. So then here we had another attempt to break out. And you see how it rides my volatility level? That's actual volatility. This isn't back tested or painted. This is actually how the volatility traded it, traded to the monthly three, rode it up, and then broke out again. Uh, this really gigantic tariff spike uh, went from 370. Let's see, how far did it go? Went from 300 to 900. So it went two times the monthly range, from 300 to 900. Look at that. And then the algos step in to send it back down. Now that's algorithmic, and that's how the dealers and the JP Morgans and everybody knows when to come in and look at that. They didn't even hit it. They stopped it right before it hit it and started selling it, front running it. But we're back inside the monthly range, heading down to this 269 points. We were at 300. So, what does that mean for the market? Let's look at our point range first. Let me put this back, restore this so that you can see the points and levels. So these were the monthly points, right? So it's showing you that we have 300 points currently in the market for this month. So if you measure top to bottom, you'll see it's 303.75 points. The monthly two range was 269 points, and you see it got a little bit above the point range for the month, but trying to come down to the 269. We hit the monthly two level, which is different than the point range. And what I have points and levels. So this is a variance trading model. And variance means that you go from the middle, the mean, out. So I'm measuring, instead of the entire 3 to 3, I'm measuring mean to 3. So when we go two times this range, here's 1.5 times and two times. I'm measuring mean to 3 to get there, not the entire time. If you take the rectangle and just do your little copy paste. Copy the 3 to the 3. Looks like I got the wrong color on that, didn't it? Instead of the dark blue, I got a cayenne blue on that last one. Let's see. So here's 3 to 3. I can get it precise. Trying to get it precise. You know what they say in horseshoes and trading, close is close enough. All right, drop it. So if I copy and paste, you can see there's your 2 times the range. And that's precise. I mean, my measurements are precise. So, um, 1 time, 2 time, and the middle is 1.5 times. And you can see that for the monthly range, it pretty much stays inside the monthly range, except for here this April. And it actually went 2 times the range. I'll show you, um, for the point range, but not the mean to 3 range. So here's your point range. What the heck? I got the wrong thing. Sorry. Make it a rectangle. It's Saturday. I'm not all here today. Not that I'm all here any day, but close enough. Okay, hang on. All right. Drag this. Oh, come on. Okay, there's my one box. Now, if I copy this, well, I don't need to copy it. Get rid of the copy. I can just adjust it going from the top of that line to the bottom, and you can see that I went just outside of 2 points from the top to the bottom. So I'd already exceeded 2 times the point range. So when it hit this 1.5 and went back up, that was the buy. Look at that. That's your outlier. That's what Simmons was telling us to sit there and wait for those. If we just traded the outliers, we would do real well. That's what he was talking about. Had this really screaming volatility, and then it went up. So where did it go? It went up to 2 times the monthly range. One, two, three. 2 times is 68%, right? Statistical. So it hit the 2 times statistical range on Friday. And it did it earlier in the day, earlier in the session, and I sent out a tweet that said, it's likely that we're seeing the high. And let me show you what it looks like on the daily um, chart, because we can put the monthly range on the daily chart. Um, which I have done. Here's the daily inside the daily, but this larger 1, 2, 3. You can see here's the 1, the monthly, there's the 2, and there's the 3, and it went right up to the monthly 2. Look at that. And if we think that the dealer is going to move risk beyond 68% of the monthly range on the last trading day of the month and the quarter, we probably need our heads examined, right? But before I make that blanket assertion, I probably want to come here and do a few things. I want to change this to a 3-month. And that will give us, look at that. This is a 3 month that almost went 2 times the range. And our distribution, that's still in the 1 month. Let's change this to a 3 month. Okay, so you can see that there is a little bit more room to go on the 3 month from 62.23 to 63.23. So if they prove me wrong and they will move risk out, that's where they would move it, in my opinion. They would not allow it to get higher than that if they move it. That's a big if. I mean, that's really a big ask. So let's put the quarterly on here on the chart. I can do that. So we can add the quarterly distribution to the chart. That's one of the great things about JATS-PT is you can add um, distributions. And you can see here we've got a quarterly 3 at 62.59.75 on the open. And let me add one more on the close. And this is measuring it from a daily bar. Hang on one second. This is the reason it's different than the monthly candle, the 3 month, is because of the difference in the open of the daily open versus the 3 month open. And then here's a close. And so it would be a difference between the calcs running from the daily close to the 3 month close. So you can see that we have on the daily range is what they don't trade a 3 month level per se, but if you wanted to be specific and see what that 3 month level is, you can add a second time series. Okay, put a quarterly range because the quarter ends this month too. All right, there's our quarterly bar. I'm going to hide it. And then I'll show you the difference between, let me just make this all big, the quarterly. So if we get a variance pop from the monthly too, so everybody can jump on Twitter and say, aha, you were wrong. I'm not wrong. It was the monthly too. It's just that they had to move risk um, to the quarterly levels because the market broke it. They're definitely going to defend that. And I'm going to put this on panel 1, but input series 3 month. There's the close. See it up here, 63.23. And then let me do one on the open. All right. So if we do get like a blast surge above that 62.39, it likely would go to the daily calcs first, 62.59 to 62.68.75, 75. And if that breaks, there's your 63.14, 63.23, which, honestly is a possibility. And they would likely put their risk outside of this quarterly close, 63.50, 63.47. The reason I say that 6,300 is a possibility is because we can look at our quick strike platform and check our 30-day. Um, First, we can look at the quarterly expiration. Well, that's not the quarterly here. It's June 30th. It's actually the calendar quarter. So June 30th. Um, for the current volatility, it's showing very low delta. So it's like on the current volatility, almost non existent that it would get there. Um, Same thing on the caps on settlement. So it's like, really, it would be the zero, the maximum amount that they could make, but would they go all the way down there? Very hard to imagine that that would ever happen. Um, and if we check our open interest to see if there's any contracts sitting there waiting for it to happen. Yeah, there's some, but there's no end of day volume. There actually isn't money. It has not contract, it's like having a limit order sitting out there. 6250 is the high call. Um, but we can verify this another way by checking our quick sheet. Oh, what did I do wrong? Here we go. Had the little pound sign in the wrong place. All right, so our 25 delta is at 63.75 for a 30-day. Um, we look for our 1 day. That's your risk reversal. Um, Here we go. It's 62.50. That's why the high call sitting there. See that? That's your risk reversal. Okay. So it's going to be a very, very low probability. In fact, you know, 62.59 would be, 62.68, probably the highest this market will go Monday, if it even gets up there. Um, but you can make note of that. They would have to hedge going from 39 to 68 or 50, 11 point hedge. And like I said, it costs them billions and billions and billions because they've got quarterly, they've got monthly, they've got weekly and daily contracts sitting on that. So it's just, whether you want to go 11, put all that money on the line to go 11 or 15 points, it doesn't make much sense now, does it? So that's where you have to use your common sense. But if you're running a spread and, want to position yourself for a little bit of a pullback, it makes a lot of sense. We have gone a tremendous amount. That doesn't mean that it won't continue climbing. Um, we see where some targets are, uh, quarterly targets. So we get a new quarter on Monday, so we'll have new lines. But sometimes the market will go ahead and fill in the last month or the last period. You know what I mean, Jelly Bean? So, anyway, we can talk about that theory later. But for tomorrow or Monday, it looks like we could probably be looking for a compressed volatility scenario. And let's take a look at these other time frames. So the 5 minute, the 15 minute, the 60 minute, the 300 minute, the market is extremely um, algorithmic, and it trades within the framework no matter how small the volatility is. If you're inside the 5 minute distribution, it won't break out of the 5 minute threes. When you go outside the 5 minute distribution, you break outside the 5 minute threes. And this is where you can trade to a higher time frame. You can either trade to the 5 minute 1.5 or 2, or you can trade to like a 60 minute time frame. So you can trade, put this on a 60 minute and trade a 5 minute bar to the 60 minute. So when you get a 5 minute breakout, you can look for those 60 minute targets. Does that make sense? Up and down. So here was a nice breakout. It actually didn't break out until we were already over the 60 minute range. So we can add a 60 minute distribution down here to help us visualize that breakout. And instead of putting it on a new panel, we can pop that right into right there. So you can see here that we broke above the 60 minute one and went up to the 60 minute three on the point range, but on the levels, uh, this is a 5 minute bar. The 5 minute bar traded past the 60, had a 60 minute breakout right here. And here, the same thing. You had a 5 minute breakdown. Here you had the 5 minute breakdown. So, can you just capture those 5 minute breakdowns with Bloodhound? Absolutely. Easily. That's one of the best things about shark indicators and Bloodhound. You can isolate when those occur extremely easily. So we're using a 5 minute bar, so we can put in a 5 minute comparison solver, put low price, low high, oops, and then on the bottom, I'm going to put the JATS PT indicator in, PT3. We don't want fibs. We're going to use a higher time frame true, and then choose the 60 minute. And then we're going to go from the PT3. So PT3 long and short right there. And I'm not sure what's wrong with my Bloodhound template. Um, well, I'm not sure what happened here. But you can see when it breaks down, we get the signal, and when it breaks up, we get the signal. So, let's see. What the hell happened here? This is doesn't look right. Let me put the close. Well, I something happened to my colors. This is just bizarre. That's okay. You can see that the signal's there. It just got color coded oddly. Always something. But when we're inside, there's no signal. It's just flat trading. But when we do get a close outside, you get a signal, and that can lead to a 5 minute, 60 minute trading strategy. So I'm going to take this bloodhound logic off. But yes, you can absolutely time this so that you can take these on any time frame, a 1 minute to a 60 minute, a 30-second bar to a 60 minute. Well, actually, a 1 minute. I don't like the 15-second and 30-second bars. 1 minute on up will work just fine on a 60-minute bar. And let me show you what that looks like. So you can take, the 1 minute break here and then set your stop, you know, and trade to these targets. Otherwise, like I said, you're inside the 60-minute range. And they are very algorithmic. They trade these ranges, 60-minute range. And there's also that 300 range, which is right here. It's the same thing as all the other ranges. So you can see here it went from 1850 to 41, so it's just a little bit over 2 times the range. And so you can see here it broke out and went, 2 times the range. And they trade inside their 300-minute 1, 2, 3. And what is amazing about this is where the market will automatically step back in once if it is breached. At that point, it's pretty much, the move is over for that time frame. And or you trade to like a daily, so you could overlay the daily on here from the 300-minute. And let me show you what that looks like. So let's take our 15-minute range and overlay, instead of a 15-minute range, which is the same thing, we'll overlay that 60-minute and 300. And a daily. Just keeping the templates consistent so that you can all right, there we go. So you can see here that they trade to these levels that went up to the 301 and then came down to the 300 1.5. Or is this a 300 1.52? It's also a 300 1.5, sorry. 1.5 to 1.5. Inside an overall daily time frame also. So having these the ability to map, let me put this on a 5-minute bar, makes it easier to see. And use these levels intraday and recognize where, the algos are likely to come in and whether you're inside a range or breaking a range to go outside. Once you start breaking down these ranges, with this R ball going straight out, then you can go in, even, on a 1 minute chart and take advantage of that. So we can have, an estimate of whether you're going in or out of these ranges on all of these time frames, but then know how to set your algo to capitalize on when the three breaks and then start trading to these outside time frames is what I'm trying to say. And you can see how algorithmic this is, even on a, especially when you're looking at a 1 minute time frame. So definitely come in and pick up the JATS PT indicator. You can run your own vol surface analysis on all of these time frames together. Um, I think it's easiest to see it um, when you're looking at the points and seeing when that one time frame is trading um, outside of its point range for that time frame and then reaching up to a higher time frame point range. So you can do, like your go from the 1 minute to a 60 minute, one, two, three, with a point range. So you would know where you were on that 1 minute excursion. If you hit a 1 minute, 60 minute three, you know pretty much that move's almost over. You can see here 1 minute going up to a 60 minute two. This is a 60 minute, isn't it? Yep. So you can put any cross time frame on any time frame move. So if you didn't want a 1 minute with a 60 minute range, you could do, a 60 minute bar on a daily range and see how far that 60 minute bar on the daily range went. Um, in fact, we can do that. So where's my 60 minute bar right here? So we can add the daily range to this. Put it on your same panel. And there we go. So you can see that a 60 minute two is pretty much a strong move. Occasionally it gets to the three. In fact, it can go outside the three. There we go. Yep, a couple of them. But normally, I mean, like if you know that your 60 minute is trading inside the daily one, you're not going to be looking to swing to those fences, are you? But when your 60 minute is trading outside the daily one, going out, you can be hitting for those outside moves, right? This is where you would want to focus on those algos right here. You see? Unscrunch this so that we can see it. So you can see right here that it broke it right here and it went to target. It went to both of them. Look at that. So it's points and levels going from the variance trading model, mean to three, versus a point range, which is high to low. So that's the only way you can measure volatility, by the way. It's either, it's open, high, open, close, high or low, right? And so when you can put your point range together with your open to the target or close to target, and the close is, the close of the bar or the open of the bar. That's where you start your measurements from versus the high or the low. Um, when I get my indicator upgraded the next time, I'm going to add the high low to it. But for now, we can just visualize the point range on these time frames. So, I would like to get, the 60-minute point range added to the indicator as a line, a level to trade to, um, from the high or the low instead of the open and close. So that we'll have the complete spread. It will be a total picture. All right. So 60-minute, 300-minute, weekly, daily, monthly, they all trade the same. I just wanted to show you that. And you can, do a lot by understanding where these points and levels are for your trading and, you know, move with the range expansion when it's occurring and learn to, sit down inside a range if it's consolidating inside the distribution and either trade your condors for premium or wait for the range expansion algos to fire off and then come in and get your points. You don't have to trade tip to toe. Just go inside, grab your points, and get out, and build your trade strategy that way. But at least knowing if you're inside or outside, knowing whether it's going to be a condor day or a range expansion day, puts you in a huge advantage to where the rest of the market is, where they're looking at moving averages or something to decide, do I take a trend continuation? What do I do? You have knowledge of volatility on multiple time frames so that you can see whether the weekly is inside or outside that 1, 2, or 3 compared to a monthly 1, 2, or 3. What does that look like? Or a daily 1, 2, or 3, or your 5 hour 1, 2, 3. And then you can combine the time frames. You can put that 5-minute distribution on a 60-minute chart or a 300 chart or a daily chart and see when those breakouts occur, um, and pick your spots to trade instead of just trading blindly. Um, you'll know solidly whether that volatility is expanding or contracting in that time frame you're interested in. All right. Thank you so much, guys. I hope y'all have a great weekend. Um, Talk to you soon.